In Chapter 15, we continue a look at various analysis that we started in Chapter 14. So we're going to move on to overhead variance analysis. So we already know what comprises variable overhead and fixed overhead. Variable overhead is indirect materials and labor. Usually utility costs are included in variable overhead or mixed overhead. Equipment repair and maintenance. And fixed overhead is comprised of depreciation, salaries, and insurance and property taxes. Looking at this graph, we see variable overhead cost, and we're looking at product costing and cost control. So we carry over those standard quantity and standard prices concepts that we talked about in Chapter 14. And we want the standard allowed direct labor hours, and the standard price is the standard variable overhead cost per direct labor hour. So variable overhead is assumed to be linear based on the number of outputs. When we're looking at variable overhead analysis, we have this is similar to our direct labor and direct materials variance analysis. We have a spending variance and an efficiency variance. Our total variance is our flexible budget variance for variable overhead. So the actual quantity times the actual rate, the actual quantity times the standard rate, and the standard quantity times the standard rate. So our spending variance is actual quantity times actual price minus standard price, and the efficiency variance is standard price times actual quantity minus standard quality. So our total variable factory overhead variance is the actual variable overhead cost incurred during the period minus the overhead cost applied to production. It should equal the over or under applied variable overhead for the period. And the total variable factory overhead variance is the variable overhead spending variance plus the variable overhead efficiency variance. The spending variance is the actual variable overhead cost incurred during the period minus the flexible budget for variable overhead based on inputs. And the efficiency variance is the difference between the flexible budget based on inputs and the flexible budget based on outputs. So let's look at an example. We're back to our theoretical company. So we're going to be using this Schmidt machinery company that was in Chapter 14. We'll also look at it in Chapter 15 and future chapters. We apply factory overhead on the basis of direct labor hours. Our standards are 5 direct labor hours per unit at a standard variable overhead rate of $12 per direct labor hour. In October, we used 3,510 direct labor hours to make 780 units and spent a total of $40,630 for variable factory overhead. So what was our overhead variance for the period? Well, our actual overhead cost minus the standard variable overhead cost applied to production at our overhead rate. We have a variable variance, a favorable variance, or we under applied overhead. So we have our actual results, then our flexible budget amount, which is our actual hours, times our standard rate of $12 per direct labor hour, and then the standard that should have been used for that production. So what we applied based on our production. So we have a favorable spending variance and a favorable efficiency variance. When we graph this information, we show the efficiency variance and the spending variance when we're looking at the dots on the graph of our different results. So what was our applied variable overhead? What was our actual variable overhead? And what is our total variable overhead cost variance? This is just a graphical representation of the equations that we looked at on the previous slide. So when we look at these, total variable overhead variance is 6,170 favorable, which we calculated on the previous slide, and that is composed of the spending variance and the efficiency variance being added together. Our spending variance results from spending more or less than expected for overhead items such as supplies and utilities. The efficiency variance looks at the efficiency or inefficiency in the use of our selected activity measure. It doesn't reflect actual overhead control. It just tells us how good our applied rate was that we calculated at the beginning of the year. Now we're going to move into discussion about fixed overhead costs. So fixed overhead costs, we believe, has the assumption is that it has a straight line or there's a controlled budget lump sum over a relevant range. So our standard quantity is our standard allowed direct labor hours for units produced, and the standard price is our fixed overhead cost divided by our denominator volume. So this is the number of direct labor hours we use to set our fixed overhead application rate. We can use different denominator volumes because that volume is based on what we believe our capacity is going to be. So we determine what the total budgeted fixed factory overhead is for the upcoming period. Then we select an activity for applying fixed overhead, direct labor hours, machine hours, or activity-based costing if we use an activity-based costing system. We choose a volume level for our selected activity. So normal capacity, practical capacity, theoretical capacity are the different volumes that we can use. And we're going to talk about those different capacity levels later in the chapter. Then we divide the amount in step 1 by the amount in step 3 to determine our overhead rate. We have a spending variance and a volume variance for fixed factory overhead. So the differences between what our actual fixed overhead incurred was, what the fixed overhead budget lump sum was, and then what was our fixed overhead applied. The difference between fixed overhead applied and the fixed overhead budgeted is based almost strictly on the volume of production. So a change in a volume of production. Did we budget to make 1,000 and we actually made 800? And the spending variance is the part that we actually look at for control. So we're going to look at example with budgeted fixed factory overhead. So we have a total overhead cost of $120,000 budgeted for October. Our activity measure for the month is 1,000 units times 5 direct labor hours per unit. The actual production was 780 units, and our actual fixed factory overhead is $130,650. So we're going to look at our spending and production volume variances. Our rate of fixed overhead is that 120,000 budgeted fixed overhead divided by our 5,000 direct labor hours, which gives us an application rate of $24 per direct labor hour. When we look at the total fixed overhead variance, this is also our over or under applied overhead. A favorable total fixed overhead variance means that overhead was over applied, and an unfavorable total variance means that we under applied overhead during the period. Our fixed overhead spending variance is the difference between the actual fixed overhead and the budgeted fixed overhead. The production volume variance is the difference between budgeted overhead and applied overhead. So when we look at these examples, we have that our budgeted overhead was $120,000. Our actual fixed overhead incurred, so our actual spending, was $130,650. And our applied overhead was 780 units times the 5 direct labor hours per unit times our rate of $24 per direct labor hour. So the fixed overhead that we applied was $93,600. We have a spending variance, $10,650 unfavorable, and a production volume variance that is $26,400 unfavorable. Those two add together to be the total fixed factory overhead variance. Why we would have variances in overhead. So our spending budget variance comes from spending more or less than expected. So the spending on individual fixed overhead items was different than we had originally planned for whatever reason. The volume variance is caused specifically because we made a different volume than budgeted. In this example, we budgeted for 1,000 units and we actually manufactured 780 units. Different reasons for the spending or budget variance when we're looking into and investigating these variances could be ineffective budgeting. So we need to relook at our budget process and figure out why our budget was so different from our spending, inadequate control of costs, or a misclassification of cost items. Do we have items in the wrong bucket of cost pools? Production volume variance is caused by unexpected changes in market demand, changes in production levels, changes in our manufacturing operations, management decisions to just decide whether or not to produce more. When we look at all of our variances together, we see that there's a four-way breakdown of our total overhead variance. So we have our variable overhead spending variance, the variable overhead efficiency variance, our fixed overhead spending variance, and the production volume variance, which is based on our number of units made. This is just another way to look at that same exact information. So we have total overhead spending variance. So the 4 level is the top level. And then we break it down to this 3 levels, the total overhead spending variance and the variable overhead efficiency variance and fixed overhead volume variance. We see the amounts here. First, we started with our 4-level analysis of our factory overhead variance with the variable spending, fixed spending, variable efficiency, and fixed volume. Then in the bottom, we see a 3-way overhead variance analysis. Total overhead spending variance, which is the variable overhead spending plus the fixed overhead spending, and then our variable overhead efficiency variance and our fixed overhead volume variance. We can also reduce that down to 2-way variance. So the 2-way variance changes that the 4, we put the variable overhead spending, variable overhead efficiency variance, and the fixed overhead spending variance into a total overhead flexible budget variance. And then we look at the fixed overhead volume variance.